Hello, welcome to our presentation with Global Risk Consultant, a team of financial risk management specialists. My name is Hung Chen. I'll be your host today. Joining me are
Nitya Yadgiri, I'm your equity market specialist.
Hi, I'm Cherry. I am your interest rate specialist.
Hi, I'm Priyudan Persia, your interest rate strategist.
In this short video, we'll be presenting a clear and practical financial risk management plan specifically tailored for Apple Inc., our client.
Our goal is to break down complex financial concepts into small ideas and explain how Apple can manage key risks like currency volatility, stock market swing, and raising interest rates.
So now let's get started.
Apple Inc. is one of the most successful tech companies in the world. They're known for their iPhone, MacBook, iCloud, and Apple Music. Apple generates nearly $290 billion in revenue each year and operates in over 100 countries. In fact, more than half, around 57% of their sales, come from international markets outside the US. However, Apple also faced some big financial challenges in 2025. Firstly, change in currency value, especially between the euro and the US dollar, can affect how much Apple earns from its overseas sales. Secondly, the company gives stock-based bonuses to employees, so if Apple's share price drops suddenly, it could impact employee compensation. And lastly, Apple has around $96 billion in long-term debt, so if interest rates go up, refinancing that debt could become more expensive. That's why it's so important.
Let's picture Apple as a ship on a vast ocean. Four hidden currents could suddenly push it off course. More than half of Apple sales arrive in euro, yen, and yuan. When those currencies lose value, Apple gets fewer US dollars back. Last quarter, a weaker euro alone shifted about 2.5% of sales. The rate roller coaster. Apple carries about $94 billion of long-term loans. If interest rate clip just one small notch, the yearly bill jumps roughly $1 billion, while the $30 billion is kept in cash hardly grows at all. Also, in April, tech stocks slid 25%, erasing almost $200 billion of Apple's value. When the share price drops, buyback plans slow and employee bonus shrink, even though iPhone sales stayed flat. Last year, chip price jumped about 12% after new tariffs and shipping delays. Every extra dollar spent on parts comes straight out of profit. Quick cost spikes can hit Apple's margins almost instantly.
Now that we have identified Apple's biggest financial risks, let's walk through the strategies we recommend to manage them. Strategies that not only offer protection, but also align with the Apple's business mindset.
Let's start with currency risk. Since Europe make up over a quarter of Apple revenues, even a small shift in the euro value can really impact its profits. That's why we're recommending a collar strategy. It's like insurance, but with a lower cost.
Exactly. It protects against the weakening euro, which is likely, but without the high price tag of other hedging tools. And because it allows some upside flexibility, it fits perfectly with the Apple's efficient and adaptive culture.
Next is equity risk. With Apple heavily relying on stock-based compensations, market drop like the 25% tax dips we saw in April can seriously affect employee morale.
Our solution here is an index-based protection. Since Apple's stock moved closely with the tech index, about a 0.89 correlation, this gives them a solid hedge against market downtowns while still letting them benefit when the market rises.
And the last one, since Apple hold nearly $100 billion in debt, while that is manageable given their cash flow, rate volatility could raise costs.
We propose a balanced strategy here, converting about half of their fixed rate debt to floating. It spreads their exposure, giving protection if rate goes up, but also flexibility if they stabilize or drop.
What I really like about our overall approach is how those three strategies complement each other. We're not just solving individual problems, we are building a comprehensive framework that works together to protect Apple's financial health.
And we have made sure these are easy to implement and understand, important for a diverse board like Apple's.
In conclusion, Apple is facing three major financial risks: currency fluctuation, stock market volatility, and rising interest rate. We recommended some hedging strategy using derivative, like options and futures, that can help reduce this risk and protect Apple performance. It's important to add now, matching risk isn't just about avoiding loss, it's about planning for the future with confidence. Our team at Global Risk Consultant is ready to help with implementation and ongoing support. We're here to help Apple to build a stronger and more secure future.